David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about higher inflation and its impact on consumerism. David, thanks so much for joining us today. And as we've discussed before, this is really a multifaceted and complex conversation. But today, can you explain to our viewers how inflation looks from your perspective and why this is of importance to investors?
Absolutely. At a high level, let's first observe that gross domestic product is 70% consumption. Said another way, consumption is simply you and I buying things. These things can be daily routine staples, or it may be a new car or an appliance. It would also include any services and other non-tangible items. Clearly, in order to consume, you must have an income or the capacity to spend. Inflation erodes your capacity to spend as prices increase faster than your income increases. As we discuss this, it is important that we do so in the context of how inflation impacts patterns of consumer behavior. If inflation rises faster than your income, then consumption generally declines. If consumption is weaker than expected, then products aren't being purchased. And if companies aren't selling more products and services, then revenues are lower than expected. Ultimately, the markets reprice for the risk that a given stock may be too highly priced for the lower than expected revenue results. This is why keeping an eye on inflation as it pertains to consumerism is very important if you're an investor.
Well, that seems like a pretty clear explanation of why we should be mindful of the potential impact of inflation on our investment portfolios. Well, David, can you provide some insight as to what inflation looks like at the present time?
Yes. You are looking at the most recent chart that depicts inflation at the producer level. From December to December, inflation at the producer level was higher by 9.7%. Prior to that, we saw a reading of 9.8% from November to November. This was a modern era record for high inflation at the wholesale level. Said another way, what did it cost the company to make this pen 30 days before you purchased it at the store? The components behind wholesale inflation are many. Clearly, supply chain disruption continues to add to inflationary pressures, but that is only part of the equation, though. And frankly, it's not the largest culprit, in my opinion. Now you're looking at a chart that depicts the degree by which the Federal Reserve has ballooned the M2 money supply. There is a precedent-setting increase in numbers of dollars currently in circulation. This is adding, in my opinion, the greatest upward pressure to the inflation that we can measure at the present time. This is not showing signs of abating, and frankly, all 10 of the leading economic indicators continue to reflect higher inflationary pressures. While I can't guarantee this, for this reason, I am reasonably sure that subsequent readings on inflation at the producer level over the short term could very well be higher than what we have already observed now.
Well, that sure doesn't seem very promising for our ability to consume at a healthy level. Well, David, does this translate directly to what we feel as consumers?
For the most part, yes. It's not a perfect translation, but in general, that which you see at the producer level will ultimately be felt at the consumer level. Now you're looking at the most recent graphic that depicts inflation at the consumer level from December to December. It was higher by 7%. This was a level of inflation that we have not seen since 1980. And again, because of what I can see at the producer level, I am reasonably sure that we will continue to see higher inflation at the consumer level over the short term ahead.
David, the business mass media has recently floated the thought that the average household income is keeping up with inflation and that this is really a healthy sign of a growing economy. But I'm guessing that you disagree with that sentiment. Am I correct?
Well, 7% inflation at the consumer level would be fine If your wages increased by 8.25% over the same period of time, that would have to happen so that after tax you were able to just tread water and keep up with the higher cost of living. For the vast majority of us, though, that did not happen. Now you're looking at a graphic that depicts the rate by which wages grew from November to November. Across all non-farm payrolls, wages grew by 4.9% on a gross basis. After tax, let's assume that you kept 4.3% of that increase. I just showed you a graphic where the cost of living rose by 7%. So if the increase in wages reflects your capacity to spend, then clearly we have a negative capacity to consume relative to previous years. I would also like to remind your viewers that there is a difference between income and wages. Wages simply reflects what you earned. Income, though, also includes anomalous items like the child tax care credit, the pandemic unemployment compensation assistance, and other one-off items that originated from the CARES Act in response to COVID. Now you are looking at a headline that I noticed on Monday morning. And within the article, we learned that just recently, Congress failed to renew the child tax credit. Starting this week, there are roughly 30 million families who are noticing their income declining because of the absence of this anomalous piece of income. So no, for the vast majority of us, the increase in our wages is of greatest importance, and clearly that is not keeping up with the cost of living.
David, what about such items as food and energy? I believe these items have increased in cost by much more than 7% over the previous year, correct?
Great point, and indeed you are correct. We can't simply stop at the headline number of 7%. There are certain economically inelastic things that you absolutely must consume, and in consistent quantities. You drive to work, you take the kids to school, you drive to the grocery store, and consume fuel in many different ways. The cost of gasoline is higher by 50% over the previous 12 months. This is taking an increasingly greater chunk of your spendable income for a commodity that you cannot do without. Furthermore, food prices are sharply higher due to scarcity of materials and labor, but also because everything that you just purchased when you went to the store the last time was not delivered on an electric truck. Fuel touches every aspect of our life. And in the case of inelastic commodities, such as food and energy, if you are required to spend increasingly greater amounts of money on these things, that leaves you with that much less to spend on discretionary items. As we have just seen, the cost of those discretionary items is rising at a rate faster than your ability to consume them. This does not bode well for future patterns of consumption. Since consumption is 70% of gross domestic product, my question is, to what degree might the market reprice for that risk that revenues won't be high enough to support current valuations? We are still near an all-time record high in the market. I am reasonably certain that that point of inflection remains in front of us.
Well, David, as always, thanks so much for this very important and timely information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.